And for more on markets, we are joined now by StoneX Financial Chief Market Strategist Kathryn Rooney Vera. And you have Christine Lagarde speaking on the sidelines of those IMF World Bank meetings. You watch the IMF come in and really reduce their expectations for global growth. But there are differences when you look through the data. And importantly, some of those differences are around the United States, where the projections were actually revised upward. When you think about equity markets around the world, you've seen money pour into Japan and Mexico, and the IMF data is showing you that growth might not be as strong as you would think outside the U.S. Does that bring money back into U.S. equity markets?
It definitely bodes well for U.S. equity markets when it's, the prettiest house on the block. But you definitely see some other economies roaring as well, especially in the emerging markets. I'm as focused primarily on Latin America. But returning back to the U.S., yes, the S&P has defied gravity and defied all risks or expectations of any negativity. So we've seen the S&P up 23%. But right now, you see valuations extended, and you see, as you mentioned, these macro risks that are really being discarded by market participants. And in an environment like this, especially 2 weeks before a very tight presidential election, I'm more cautious than consensus, Shonali. And what I would be suggesting to our clients, and what effectively I am in my global roadshow and my trips, is to protect your earnings. So yes, tech has done phenomenally well. And right now, that's a great time to be buying options that are relatively inexpensive to protect those earnings, not liquidate, not sell, but protect them.
Well, speaking of protection, if you take a look at the S&P trade today, it's fascinating to see another down day after a down day yesterday. And we had a flurry of earnings as well. And even companies that had fairly promising guides didn't seem to really meet the bar for investors. 3M, for an example, raised their guidance once again, the second time under a new CEO. Yet it didn't really meet expectations. Where we stand today, are valuations just too high? Is the bar just too high for earnings?
Well, you make a good point. I wonder if the bar is too high, but I also wonder if this is such a forgiving market, indicative of its resiliency, Shonali, that even when there is a miss, the market is ready and willing to forgive that miss. So I think it's more of a sample of, or an example of a market that's ready to be bullish and ready to discount, well, maybe there's a miss this time, but we're going to be okay in the future. Precisely because corporate earnings are near records or at records. They're phenomenal. So far, so good. But I think a lot is priced in. And we talked about these macro risks. We have oil prices moving higher. We have geopolitical risks. We have inflation risks that are inherent in fiscal policy. And I think these are things that over the past 2 days, we're seeing the market take into consideration. The fact that the U.S. economy is really outperforming expectations and growing above potential, which is inherently inflationary, tells the market, and effectively what we're seeing is a repricing of expectations on Fed rate cuts into 2025. So I would suggest, and what I am suggesting to our StoneX institutional clients, is to make safer bets right now. So look at earnings that are reliable, predictable, and resilient, and can be resilient to a potentially higher interest rate environment for longer. And dare I say it, if we get a reacceleration in inflation, let's say we get a sweep one way or the other with the fiscal deficit spending, with protectionism, with robust growth, all of that, means higher growth, but also means potentially stronger inflation. So I think the risk shouldn't be ruled out that the Fed isn't able to cut, and dare I say, maybe even run the risk of having to resume hikes, depending on how the scenario unfolds in 2025. Not my base case, but something that I think that investors would be wise to consider in their portfolio positioning.
I'm glad you brought up interest rates here, because the move in the 10-year has been spectacular. And if you think about the idea that we're back to 4.2%, and you saw that note out by the head of fixed income, the CIO at T. Rowe just a day ago, this idea that the 10-year could get back to 5%, and it's a risk you have to bake in. What's the spillover effect? Because right now, that is the minority view in the market.
It's so interesting. I'm here in Miami. I was last night at the ABS conference, the Structured Finance Conference here, and all the investors were talking precisely about this. How incredible it is that the Fed has launched a rate cutting cycle with 50 basis points out right off the cuff. And, we see the 10-year Treasury moving higher. So that's not helpful to the housing market. And I think that it's not helpful to the equity market when you consider how extended valuations are. We're up 23% in the S&P. And how much more upside can there be? There could be. We're a momentum-driven market at the moment. But the risks are underpriced. And I think one of those risks is a 10-year Treasury that not just stays at 420 or wherever it is at the moment, but potentially moves higher. So I do think that it's time to protect portfolios.
What is the biggest risk? Because if you think around the corner, we're 2 weeks away to the day from the U.S. election. There are a lot of people betting one way or another already, unclear what those wagers look like into next year. How are you thinking about the risks?
Look, right now in the rates spectrum, I like the steepener. I think that everyone's talking about the potential for a Trump win. And if there is not only a retake of the White House on the Republican side, but also a sweep in Congress, I think that you're going to get a rip in the steepener trade, which means that higher deficit spending on either side. We're going to get higher deficit spending. No one's talking about fiscal conservatism here or responsibility. We're probably going to get some form of trade war, more likely than not under Trump versus Kamala Harris. But either side, both sides, and I would even say globally adopted, is this phenomenon of industrial policy, which is, in my view, and this could be controversial, is a euphemism for protectionism. Everyone's talking about tariffs and sanctions and quotas. So all of that is inflationary. And Shonali, one other point that I made before is that the output gap in the U.S. is positive. So the economy is growing above potential, which itself is inflationary, not to mention the potential for a conflagration in the Middle East and the positive impact that would have on oil prices, which trickles into the real economy. So I think the biggest risk is that we continue on this current trend. We get additional oomph to the U.S. economy, and we get a resurgence or reacceleration in inflation. And I think that the market is wholly unprepared for that and not discounting that in the remotest.
Kathryn, thank you so much for your time. That is StoneX Financial Chief Market Strategist Kathryn Rooney Vera.